Should NRIs invest in the Indian stock market or focus on international opportunities? If you've ever felt caught between the growth at home and stability abroad, you're not alone. Let's take a look at the numbers. Over the last decade, India's Nifty 50 index has delivered annualized returns of about 12 to 13%, handily outperforming a typical 10-year fixed deposit. And beyond just big figures, NRI commitment to India's markets is stronger than ever. For example, in 2025, the average monthly systematic investment plan or SIP contribution made by NRIs was 6,486 rupees, more than double the industry average and 58% higher than what resident Indian investors commit. What's even more compelling? Over 75% of NRIs stay invested for 5 years or longer, showing a real deep-rooted belief in India's growth story and in long-term wealth creation back home. India's investment climate is at a rare crossroads right now. Expert consensus is that the window for easy entry, tax benefits, and strong fundamentals may not remain this wide open forever, as global capital increasingly turns towards India's story. So the question shifts from should you invest to how can you capture this opportunity effectively? In this video, you'll get a practical step-by-step roadmap, the right accounts, how to use PIS and non-PIS options, critical tax and compliance do's and don'ts, plus real-world risk management. By the end, you'll know exactly how India can fit into your global portfolio and how to do it the right way. Quick disclaimer before we dive in. This video is for education and general awareness only. It is not personal finance or tax advice. Your situation will be unique, so always double-check the latest rules and speak to a qualified advisor before acting on anything we discuss. Welcome to NRI Shala. I'm Malvika, and this is where we navigate NRI life together, from visa guidance and investments to maintaining your roots while building your future abroad. Choosing to invest in India is more than a numbers game. It's a vote of confidence in one of the world's most dynamic economies. That's why thousands of NRIs are already putting down roots, not just with money, but with a long-term commitment. India's robust market returns are powered by a potent mix: a youthful population, a surge in consumption, global IT leadership, and government reforms that are making the financial sector more inclusive every day. Of course, some currency drift, typically a 3 to 4% annual rupee decline versus the dollar, is reality. But if you plan to spend or support a family in India, the impact is often smaller than you think. It's also worth noting that India is unique compared to other emerging markets. The sheer pace at which domestic mutual funds, systematic investments, and even digital assets have grown reflects not only gross returns, but a culture of regular, disciplined wealth building that NRIs can access through the right channels. And as we just saw, the high SIP participation and strong holding periods among NRIs show that staying invested does pay off. But to join this wave, you need to set up your foundation first. So how do you make sure your money is coming in and flowing out legally, efficiently, and ready for investment? Let's clarify the core accounts every NRI must know before diving into Indian markets. It doesn't matter what you're investing in. Every journey starts with a right bank account. As an NRI, you're required to move away from standard residence savings accounts and park your funds in designated NRE, NRO, or FCNR accounts. The NRE account is your clean slate for foreign income, tax-free interest, full repatriability, and seamless investing. NRO accounts handle domestic income, think rent or dividends, but with a repatriation cap and higher taxes on earnings. FCNR deposits let you benefit from Indian rates without rupee risk, as the money stays in foreign currency. And before you even invest, you'll often need to move money from your country of residence into these accounts. Money transfer services such as Aspora can help NRIs send funds to India at competitive foreign exchange rates with transparent fees and compliant routing. These accounts are not just a formality, they're hard checkpoints enforced by RBI, FCNR, and SEBI regulations. Without them, even the best investment opportunities remain off limits. Think of these accounts as the gatekeepers to every investment you make in India. Pick wrong and you can hit roadblocks. Pick right and everything else becomes smoother. Before you invest, banks will also require compliance with stringent KYC, know your customer, and often FATCA or CRS norms if you're based in the US, Canada, or Europe. Make sure your documentation, which is passport, visa, PAN, proof of address, is in order, and expect regular re-verification. So now you're set up. But how do you actually get your investments into the markets? And what's the difference between a PIS and a non-PIS route? Let's break it down. Getting your account right is only half the challenge. The next step, navigating how you actually put that money to work through the right investment routes. If you're looking at listed stocks, Indian regulations require most NRIs to go through the Portfolio Investment Scheme or PIS. This means you'll work with a compliant broker, open an NRI or NRO PIS account, and ensure all trades are properly documented with the RBI. There are ownership restrictions, no more than 5% per company for an individual NRI, and an aggregate cap for all NRIs. It is to be noted here that the RBI has proposed an increase on this limit to 10%, but as things stand, the limit is 5%. For those who want a less hands-on but still rewarding approach, mutual funds often operate under the simpler non-PIS route. Most leading mutual funds allow NRI participation with standard KYC through NRE or NRO accounts, helping you tap the market without dealing with the intricate routing PIS requires. A quick but critical update. If you are an active trader, you should know that NRIs cannot trade intraday or engage with commodity and currency derivatives whatsoever. However, trading equity futures and options is possible, provided you do it via an NRO non-PIS account with a CP code set up by your broker. Here's a quick tip. Don't forget, many top-performing PMS or Portfolio Management Services, AIF, which are alternate investment funds, and gift city opportunities are also increasingly being open to NRIs under SEBI and RBI rules, especially if you're looking to allocate 50 lakh rupees or more and want a professionally managed approach. So your money's in, your route is clear. What about taxes? Let's explore how much of your gains you truly get to keep. Now for the bottom line, how taxes and treaties affect what stays in your pocket. Short-term capital gains from listed equity shares and equity-oriented mutual funds, meaning investments held less than 12 months, are now taxed at a flat 20% rate plus surcharge and cess. This is a recent change, replacing the former 15% rate. If you invested before April 1st, 2023 and you sell after July 23rd, 2024, you may still qualify for the 12.5% long-term capital gains rate. But note, no indexation. From April 2023 onward, debt mutual funds and fixed deposits are taxed at your slab rates with no indexation regardless of how long you hold them. Dividends are deducted at source at 20% unless your country's tax treaty allows for a lower rate. Remember, TDS is triggered once your total dividend or interest income exceeds 10,000 rupees in any financial year. Interest is a mixed bag. Tax-free from NRE or FCNR, heavily taxed from NRO, and NRO has that $1 million annual repatriation cap. If you are investing from the US or UK, special rules under each country's tax treaty come into play. Double check with a qualified advisor to ensure you don't pay more than you need to, both abroad and in India. Keeping up with Indian budget changes like those issued in 2024 and 2025 will help you avoid surprises. NRIs are eligible for DTAA treaty benefits. Know your rights. File a tax residency certificate and Form 10F and you could save thousands by reducing withheld taxes. But accurate compliance isn't just about tax. Let's connect to the one thing that can undermine all this: the real-world risks of investing as an NRI and how to sidestep them. Here's the story no one wants, but everyone needs. What can go wrong, and how do you stay protected? Volatility is a fact of life. India's markets can swing on news, policy shifts, or global shocks, and the rupee can move just as unpredictably. If your end goal is repatriating money, even small currency shifts can eat into your profits. Legal complexity is a classic pain point for NRIs. Title disputes, unclear property rights, or fraudulent filings can blindside uninformed investors. Always check credentials, work with professionals, and stay on top of compliance. Pay close attention to the can and cannot rules. NRIs cannot buy or transfer agricultural land, farmhouses, or plantations unless inherited or gifted by a specific resident family member. Parents, siblings, spouses, kids, grandparents, grandchildren, or the spouse's close family. You are not permitted to trade intraday or in any commodity or currency derivatives. Equity F&O trading is possible only under strict NRO, non-PIS, and CP code compliance. Ownership is capped by regulation. An NRI cannot own more than 5% of a single company. All NRIs combined are capped at 10 to 24% depending on the company's policy. For any major transaction, especially in property or unlisted assets, always insisted on RERA compliance, SEBI-registered partners, and written legal opinions. NRIs are often surprised by India's documentation culture. Local advice can save months of hassle. Staying informed and working with professionals isn't just good practice, it's essential protection for your wealth journey. Which brings us to the final piece of your NRI investment puzzle: the full range of wealth-building options at your disposal. Indian markets offer more than stocks and mutual funds. Consider fixed deposits in NRE, NRO, or FCNR accounts, each with favorable tax and repatriation features. Government, PSU, and infra bonds appealing for steady, medium-risk income. The real estate sector outside of agricultural land remains a favorite for many NRIs, and REITs now let you diversify real estate exposure with a click. Insurance and pension plans designed for NRIs offering tax and legacy benefits. Portfolio management services, or PMS, and alternate investment funds, or AIFs, are now SEBI regulated and designed for higher ticket sizes, letting you access strategies used by India's ultra-wealthy for a fee. The National Pension System, or NPS, is open to NRIs with full repatriability. 60% of the corpus is usually tax-free, while the rest is used to purchase an annuity, taxed at slab rates upon payout. When building wealth, match investments to your specific risk appetite, objective, and liquidity needs, and treat this video as a starting point, not a personal recommendation. Before acting on any strategy, sit down with a qualified financial or tax advisor who can look at your full situation and help you decide what actually fits you. In summary, India stands as a compelling opportunity for NRIs, delivering superior growth, portfolio diversification, and favorable tax regimes if you understand the rules. Start by choosing the right accounts. Pick your investment routes wisely and optimize your tax filings and manage regulatory risks prudently. Make documentation your best friend. Ensure you partner only with regulated entities and never rush an investment decision without full compliance. The conditions supporting strong NRI investment may not last forever. Now truly is the time to act. Thank you for watching. If you found this guide valuable, please like, share your questions below, and subscribe for more insights into smart NRI investing.